to join me this morning. We are recording this session today, so everybody right now currently is in listen-only mode. And if you have entered your audio PIN number, that will enable me toward the end of the webinar to unmute you to field any questions you have as a result of what we covered today on the new product from Mutual of Omaha. We are truly excited about getting back into California with Mutual. It's been almost 3 years since they pulled out, and we're back with a really strong offering. We just finished up a 2-week road trip of doing live seminars down your way, and they were highly successful, well received, and we hope that you'll pick up a few new pointers as a result of joining me today on this webinar too. If there's 3 things that you could take away from today's meeting, it would be these. You can't find a stronger business partner today than working with a mutual company, especially Mutual of Omaha. All of their focus is inward on the policyholders as opposed to outward on shareholders. They have the ability to do more long-term planning, and which allows for a lot more flexibility, long-range planning as opposed to short-term quarter-over-quarter. Yes, they've had rate increases. Just about everybody now has had rate increases, but with the nature of mutual companies, the rate increases are nominal, like 30% or less, or even in most cases 15 to 20%. And again, if you work with us with the United of Omaha chassis before it was pulled out of California, it had that built-in cash benefit, which we think is vitally important to have in any policy on a going forward basis. And that cash benefit is still with the new product, the Mutual Care Solutions custom and or secure product, allowing for the ultimate flexibility on a going forward basis as far as covering long-term care services that are just a twinkle in somebody's eye right now. And we'll show you a couple of different examples of what I mean. And then a lot of flexibility in the inflation protection. At first appearance, it might look like it's confusing or there's too many options. What you'll see is it allows you the ability to dial a premium in for your client that kind of makes sense. We all know that policies for long-term care in particular have gotten more expensive in the last few years, especially in the area of inflation. So allowing you the ability to dial it down to a number that makes more sense, we just think is key for separating the mutual offering from others that are out there. What we have found in the last few years is as even quoting software allows you to spreadsheet the carriers, all you're looking at is price, and we think you should look more at the value or actually the policy that you're offering versus just the price. Because sometimes the price may be a little bit higher, but the value is significantly higher than another carrier that might have a really inexpensive type offering. So just keep that in mind, because when you're spreadsheeting price, you're not spreadsheeting equally across the benefits of the policy and what it has to offer. As I mentioned earlier, the company is very strong. They actually have a brochure that we can send you if you'd like, that you can hand out to your clients, called Strong, Stable, and Secure. It does have tremendous brand name recognition. And they do continue to have innovative products. Like for example, they are one of the only ones out there right now that have the cash benefit, one of the very few that offer anything less than 3% compound, just as a couple of examples of what they have to offer. They do have very firm and stable financial ratings with an AM Best of A+, so you should feel confident in walking around and representing Mutual of Omaha with long-term care or any other products that they happen to offer as well. There are 2 marketing packages to the new product. It is all one policy, but there are 2 packages that we put together on it, the Custom Care, or the Mutual Care Secure and the Mutual Care Custom. And I'll show you the difference here in a minute. If you are serious about the long-term care market, you will probably be spending more of your time in the custom sandbox than in the secure sandbox itself. And I'll show you a couple reasons why. With the secure package, it's a traditional build. You buy a 2, 3, 4, or 5 year plan. whereas with the custom, you're buying a pool of money, anywhere from a minimum in California is actually $75,000 to a maximum of $500,000. The elimination periods available with the secure are 90, 180, and 365. Whereas in the custom, if you wanted to go less than a 90-day elim, you can dial in the 0-day, 30, or 60-day elimination period as well. As I mentioned earlier, the cash benefit on the secure is at 30% versus 40% with the custom. And this percent is based upon whatever your monthly home health care benefit is. So if you're ever thinking about, when you build a policy, you want to make sure that you leave the home health care benefit equal to the nursing home benefit. If you think about reducing it, you're going to have a direct impact on the amount of cash. And the way this cash benefit works is just like it did on the old United chassis. It's an either-or scenario. You either request a check, and they'll write you a check for 40% of whatever your monthly home health care benefit is, or you're accruing bills and submitting those bills to get reimbursed for expenses you're incurring at home. The beauty of the cash is that you can do anything you want with it, and we'll get a little more, give you a few ideas here in a few minutes about how you can use that cash. There are some riders that are available only on the custom and not on the secure. If you want to have joint waiver of premium, which is where if one goes on claim and stops paying premium, both people of a married couple stop paying premium. If survivorship is important to you, if you have a married couple where there's a big difference in age, it might make sense to put the survivorship benefit on there. It's not available on the secure, but it is available on the custom package itself. And there are a couple flavors of return of premium that are available on the custom, not on the secure. If you want full return of premium, which means all premiums paid in, death at any age, minus any claims paid out, that's available on the custom only, as is the return of premium if death occurs prior to age 65. Not available on the secure. And then when I mentioned earlier the flexibility of the inflation protection options, on secure you have 3, 4, and 5% compound, where on the custom package you have anywhere from 1% to 5% in 1/4 point increments available to you. And I'll show you some examples on how that can impact the premium when I bring up the software toward the end of the presentation today. And then also with the custom, if you do buy less than 5% compound, it does come with a built-in buyout feature. So if you started off with 1% as an example, on every year at your policy anniversary, you can request to increase that number to a bigger number without any evidence of insurability. And then with the custom, you can cap the inflation growth at 10, 15, or 20 years as well. And these dial in pretty well depending upon the age of the clients you're working with, as far as capping the growth at an expected claims age, as an example, at age 85. On the secure, you can cap the 3 and the 5% compound at 20 years only. So as I mentioned earlier, we think cash is king. It does afford your client/policyholder the ultimate flexibility and control at claim time. If they want to pay a family member or a friend to take care of them, if they want to do a private hire off Craigslist, if they want to buy some equipment that is not covered under the policy itself, the cash benefit will afford them that complete and total flexibility. It will never go away. I mean, it will never become obsolete. We don't know what services are going to look like in the future, and we don't know what policies are going to be, or what types of services are deliverable, let alone equipment that could be having a direct impact on a long-term care claim. It wasn't that long ago that policies were nursing home only, and then came along some standalone home health care, and all of a sudden assisted living showed up. The policies today are static. They're written, the black and white are written for what long-term care services are available today. Not knowing what's going to be around in 10, 15, or 20 years, having a cash benefit will allow this policy to evolve over time. And as a new service becomes available, if the black and white of the contract won't cover it, then rest assured that cash will go a long way to help pay for it. Here's an example. Just about every long-term care contract out there has specific language in it that covers medical alert systems. And these medical alert systems have kind of become almost passe. It's the old, up I've fallen and I cannot get up. And you'll see down here this phone cord that plugs in. You know, most of the now generation wouldn't recognize a phone plug. Everything is wireless nowadays. And sure, some of the medical alert systems have become wireless, but there are some things that have already been developed that are available, like floor sensors for monitoring for a fall, or even motion sensors around a facility to keep an eye on where people are throughout that facility. There's actually a wristband that come out now. It looks a lot like a Fitbit, but actually monitors what's happening with the Parkinson's patient. So things are happening fast and happening now. For example, there is already a technology out there. Well, it's not a technology, but it's a long-term care facility called a granny pod. It's like a modular home that you can plop in your backyard, and it's a self-contained unit. It has cameras in it, floor sensors in it, special lighting, monitoring equipment, so that you could keep mom or dad at home longer as opposed to having to move off to an assisted living facility. Those aren't covered by a traditional contract today, but cash can go a long way to help pay for those type of features. Electronic pill boxes are not that far away, where they'll have a reminding system, not only for the person to remind them to take the meds, but also an alert to whoever's monitoring that to notice if someone has missed a dose of a certain medication. So that's the cash. And now we're going to talk a little bit about the other strength of the policy here with Mutual. It's the inflation protection. What this chart is showing you on the screen right now is the percentage or the amount of premium for a routine build of a policy of $4,500 a month, 3-year benefit period with 5% compound, at age 45, 55, and 65, on how much of the premium is tied to the inflation protection. It really has become the majority of the cost of any long-term care policy. So we've seen a trend in the last probably 5 years, people moving to 3%, and 3% has become the new norm over 5%. And it is exactly half the cost of 5%. But you can go even lower. As I mentioned earlier, you can go all the way down to 1%. And if you get at least 1%, at least now you're in the game. You can, because of the built-in buyout feature, you can now move that number to a bigger number in the future if you feel like the 1% is not big enough. And you as an agent should feel more comfortable offering less than 5% compound, knowing full well that your client does have the right every year to increase that number to a bigger number on their policy anniversary. That can be done for the first 20 years of owning the policy or at age 75, whichever happens first. And as I mentioned earlier, you can actually break these percentages down into 1/4 point increment. In a 1/4 point increment for a 60-year-old on a $4,500 per month plan, that could be plus or minus $300, up or down. So keep that in mind. I mean, that $300 could end up making or breaking a sale for you. So don't be afraid to move around with the various percentages, especially even less than 3%. And again, at certain ages, the 10, 15, or 20-year cap kind of kicks in, and it does make sense. And as I mentioned, it does have the built-in buy-up option. There's no additional underwriting. As long as you haven't been on claim in the last 2 years, you can. It's available on every inflation option less than 5% compound, even on the cap benefits. The buy-up feature is there as well. And as I mentioned, the offer expires after the 20th anniversary of the policy or at age 75. And you pay an attained age rate just for that incremental difference you add if you do elect to add to make that number a bigger number with inflation protection. Here's an example of 1, 2, or 3% compound and how it grows over time based upon an initial value of $150,000. So you may think 1% is not enough, but you know, if you look in 30 years, that policy has grown by $50,000. It wasn't that many years ago when 5% compound wasn't even on a policy. The earlier long-term care policies, you bought your benefit, and that was your benefit regardless of when you went on claim. I think it was CNA at some point in time made the decision saying, hey, why don't we throw in this thing called inflation protection, and oh yeah, well, we'll just grab this magic number of 5. And the whole industry followed. So it's very, very interesting how that worked out. But we've seen that there's a definite bona fide need to buy less than 5% compound just from from a premium perspective in the premium tolerance that your clients may have or not have as far as writing a check for a long-term care policy. So what I'm going to do now is I'm going to pop out of this and go into the illustration software. Hopefully everybody can see that all right. Then I'm going to go through and I'm going to slowly start unmuting people. I want this last part of the presentation to be as interactive as possible. If you do have me on a speakerphone, if you could please take me off or mute me or mute yourself off on a speakerphone so we don't hear any unnecessary noises in the background. But I'd like to make this part of the presentation as interactive as I possibly can. So hang on a second here. Correct. All right, somebody has me on a speakerphone. If you could please take me off speakerphone, I would sincerely appreciate it. Okay. So if you haven't been exposed to the illustration software before, give me a call after the meeting. Again, and I'll give you our phone number up here again. I'll give you the link to download the software here in just a minute. But with the mutual product, you've got a married one insured discount and a married two insured discount. The married one insured is 15%, and the married two insured discount is 30%. The rates are gender distinct, so you have to make sure that you've got either male or female selected if you're quoting a single person or a married one insured person. You can input a birthday or birth date versus just selecting an age. And the software follows the Mutual of Omaha rule, which is the company will go back 30 days from the day you're running a quote here as an example to save age. You know, bring up a picture of a birthday cake if it actually is saving age for you. You got 4 underwriting classes, preferred, standard, right up to class 1 and class 2. The software will default to select or standard when you open it up. And we do recommend that you do quote select rates at all times. If your client qualifies for preferred, they will automatically get that during the underwriting process. It's very easy to select the monthly benefit. You can hit this little down arrow anywhere from, in California, the minimum is $3,000. The max is $10,000 as far as a monthly benefit. You can go all the way up to $500,000 depending upon the monthly benefit you select. The plan length with the custom cannot exceed 8 years, or I think it's 8.33. But again, the software will not let you do anything that is not legal as far as building out a policy. So it's got your back, in other words. Here are your various elimination periods, and here's where we get into the inflation area, whether it be lifetime capped at 20 years, 15 years, or 10 years, or no inflation at all, anywhere from 5% compound all the way down to 1% compound. And you can cap all of these at the various lengths depending upon the age of the person you're working with. I usually recommend looking at the 20-year when you're working with somebody in the mid-60s. Gives them good growth up until age 85 or 80, you know, the mid-80s. Someone who's about 70 years old, the 15-year cap kind of kicks in and makes sense. And then if you're working with someone a little bit more senior that are still relatively young when it comes to long-term care, you can look at capping it at 10 years. These are all very effective ways of dialing in a premium that kind of makes sense for your client. There's nothing wrong with quoting 1%. In fact, the saying here is 1 is better than none. If someone is kind of balking at the actual cost of inflation protection, there's not that much of a difference between having none, and here's the premiums for none, versus selecting 1%. So if they get at least 1%, they're in the game, and they can always bump that number up in the future, whereas if they start off with none, they are at none, and they cannot ever increase it in the future unless they reapply for new coverage. Out of the factory, the residential care facility benefit in California and the home health care benefit are equal to whatever you select for your nursing home benefit here. You can reduce these numbers, as I mentioned earlier, but we usually recommend not, especially in the home health care. If you reduce the home health care benefit, you are having a direct impact on the value of the cash benefit. And I'm going to just real quickly just kind of show you what we've been quoting a lot of up here lately. It's kind of the new norm. $5,000 a month, 3-year period, or $180,000 pool, 90-day LM, 1% lifetime compound, leaving everything else at 100%. And if it's a married couple like this couple here, I usually will entertain putting on the shared care rider. And that's how we've been, the majority of the quotes that we've been doing out of our office here for about the last year, year and a half. This is what's being bought out there. It's a lot different than a few years ago when everybody was buying 5% compound and lifetime benefits. Just because of the way the newer policies are being priced out, you have to start rethinking about how you build a policy in order to make it into a premium that is tolerable to for your clients. Here are the various return of premium riders available to enhance a policy. The one I didn't describe earlier is this 3 times MMB. What that is it will return 3 times your initial maximum monthly benefit. In this example, it would be $15,000 upon death, to your named beneficiary. So it's kind of like buying a little burial plan, and it's not very expensive to add. You'll see if I add it here. Well, my clients are too old. You can't have it with shared care. Let me turn the shared care off. Then we go back to none and add it. So it only adds about $300 a year for the couple to add that. So you can think about that. The thing, like I mentioned earlier, it's like adding a burial plan onto your long-term care policy. The return of premium prior to age 65 is also not very expensive. In fact, in this case, it's actually less expensive, and that's one reason they're both age 60. The max age where you can buy any of the return of premiums is age 65. So the closer you get to age 65, the less expensive that rider will be. The full-blown death at any age, return all premiums minus any claims paid in, has a significant impact on their premium. You'll see it almost triples the premium here in this example. Couples benefits, like I already turned the shared care rider on once before. It's about a 12% cost to add the shared care. There are 2 benefits to that rider. The first being if one were to go on claim and exhaust his or her policy benefits, they can then dip into their spouse's policy. The rule there is they have to leave their spouse with at least 12 months worth of coverage. The flip side benefit to that is if one were to go on claim and pass away after only a few months, whatever is left in their pool of money transfers to their surviving spouse with no impact to the premium for the surviving spouse's partner. Actually, the premium for the surviving spouse will actually come down a little bit because they'll remove the cost of the shared care rider as well. Survivorship is just that. One of you have to die. And the rule with mutual is that you have to be alive for the first 10 years of owning the policy. And if after the 10th anniversary one were to pass away, the surviving spouse's policy is considered to be paid up. No more premiums are due. Unique to mutual, as opposed to other companies that offer survivorship, is you could have been on claim in those first 10 years. So one could go on claim in year 8, pass away in year 11, and the surviving spouse's policy is paid up. Most other carriers require you to be alive and claim-free for the first 10 years. Spouse waiver of premium, more commonly called joint waiver of premium. If one's on claim and they stop paying premium, they both stop paying premium. Very inexpensive rider to add at 2%. And then if you are working with a married couple and it's clearly obvious that one of them is uninsurable, like maybe during the course of the interview, the wife or the lady of the house says that she was just recently diagnosed with MS, which is an uninsurable condition, then you could consider talking about this particular rider right here. It's called the Spouse Security Benefit. It was on the Assured Solutions product, on the Gold product when it was in California. What it is, it's a rider that is bought by the healthy person, and when that healthy person does trigger a claim on themselves, as they're getting reimbursed for expenses that they're incurring for their own care, the company will write them a check for an additional 60% of whatever they're reimbursed for that month. The thinking being that those additional monies could be used to help offset the cost of care for the uninsurable spouse. So it's not a benefit for the uninsurable person, it's a benefit for the policyholder, the healthy one. Just to give them, the idea is those extra monies could be used to help offset the cost of care for the uninsurable one, but those monies can be used actually for anything. If the uninsurable spouse needs help sooner than later, they cannot get access to that money. It is only there once the policyholder himself, his or herself, triggers a claim. It's not perfect, but that benefit has helped many agents conserve many sales, or at least be able to keep a conversation going when you're working with a couple, one of them is clearly uninsurable, and they tell you that they're absolutely not going to buy anything unless you can find some kind of coverage for both of them. There are additional discounts to be had from Mutual of Omaha. If you were to set up, say for example, your local Chamber of Commerce as an association with Mutual of Omaha, the owners of the companies who are the members of that chamber would be eligible for an additional 5% discount along with their spouse as well. If you were to buy a policy for yourself, there's a 5% discount for agents who work with Mutual of Omaha as well. And then Mutual pulled out of the multi-life or the group game well over 2 years ago, and they're not back in it either, but they have a program called a Common Employer Program, where if you are working with an employer and there are at least 5 employees of that company that want to buy long-term care insurance and they all apply at the same time, they will get an additional 5% discount, but they're working on a direct bill. They cannot be list bill, they cannot be done through a payroll deduction through their employer. It has to be direct bill, whether it be EFT, quarterly, monthly, or monthly, semi-annual, or annual. No affiliation at all with the employer group. And the reason why is that, as I mentioned earlier, this new policy has gender-distinct rates. And it goes clear back to the Civil Rights Act of 1965, where it states that any and all insurance products offered into the worksite have to be unisex rates. And so since we've gone to the gender distinct rates with Mutual of Omaha, that it makes it impossible for this product to be put on as an employee benefit through a payroll deduction. So that's kind of a feel for the new policy. Again, like I said, we're truly excited to be back in California. We do have all the supplies here available either in PDF or hard copy, so feel free to call us and place an order. For those of you who don't know our phone number, it's 800-672-7202. If you were to give me a call after the webinar, I'd be happy to spend some time with you, give you the link to download the illustration software so you can do your own illustrations, or we'd be happy to continue doing illustrations for you up here as well. So does anybody have any questions at all of me right now about Mutual or the new product? Bruce, you had put a question in earlier. Did I address it at all, or do you want to pose it again?
Hello, you there?
Yes, I am.
Okay, I'm going to hang up now. I'm just calling from California. Wanted to let you know it's another informative, outstanding informative webinar. So everything is right on point, and I look forward to trying to place this for you guys.
Great. Who am I talking to?
Christopher Hawk, and I'm in Los Angeles.
Oh, great, Christopher. Thanks. Have a great day, a great weekend.
Bye-bye, sir.
Bye. Anybody else have any questions of me or about the product or anything going on here at American Independent Marketing?
This is Cindy. I have a question about combinations in the plan design.
Okay.
It's nice to see the survivorship rider available. I'm curious if it can be done in combination with shared care.
I think it can. Yep.
Woohoo! Okay. And does the product come, I may have missed it, does the product come with the option of immediate access to home care benefits when you're selecting a 90 or 180 day? Oh, okay, there it is.
Right there. This is the home care waiver right here.
See it. Okay,
yep.
Thank you.
That rider can, I think it's worth every penny because there's no elimination period for the cash benefit. So if you start off on cash, it's in lieu of any other policy benefits, including satisfying your elimination period. So if you buy this rider and you start off on cash and say 2 months later you've got things figured out and you want to go on and get traditional reimbursement because you found the home care agency of your dreams, you're immediately on policy benefits with the home care, with the waiver of the elimination period. And once you receive your first day of care at home from a home care agency, that starts the clock to kick off the 90-day elimination period you have for the policy. So if you're at home receiving benefits and you're at home for 90 calendar days, you've now satisfied the elimination period for the entire policy.
And you've also waived your premium immediately.
Yes, true statement. Because you waive, as soon as you go on the cash benefit, your premium is waived as well.
Okay. Great. Thank you.
You're welcome. Any other questions?
Dave, can you hear me?
I can.
Dave, Bob Brody, California.
Hey, Bob.
Good question for you. Do you want me to have you send me that PDF and hard copy now, or want me to call you after the seminar's over?
Give me a call after the webinar, Bob, and we can have a chat.
Gotcha. Okay, call you shortly.
Okay.
Any
other questions? Thank you. Any other questions?
Okay.
Like I said, we did record this session, so it will be available for your reference as early as this afternoon. So we record all of our webinars. They're all up on our website, thyaim.com. You can go back. I've been doing these for a year and a half. You can go back a year and a half on various topics and learn about METS-UP, CI, final expense. We've done just about every topic you can think of. All right, if there are no additional questions, once again, thank you all for taking the time to join me today. I do appreciate it. Have a great weekend, and we'll be in touch soon.